You guys just say hello to the camera or wave. So we also today have Errol Arkilic. He is going to be your guest speaker today, and he's going to be talking about funding pathways for research-based ventures. So we're really excited to have him. Thanks for joining. And before I really introduce Errol, I'd like to turn it over to Roman to just say a few words. So I'm going to stop sharing.
Great, thank you, Katie. And I believe that we are recording this, so if you'll be able to watch this later, so you don't have to worry about taking detailed notes. And we will make the slides available as a PDF at the conclusion as well. So I'd like to thank the I-Corps sites at the other schools in New England. All of them offer the NSF I-Corps customer discovery training. So if you are a researcher and considering a deep tech startup, the I-Corps program can help you. If your school is an I-Corps site, they may be offering a course, so check with them. The New England I-Corps node at MIT also offers customer discovery training. So if you're from MIT or from a university that is not a site, or if you are and the schedule doesn't work at your school, you can enroll in one of our regional short courses. They're all virtual, so it's easy to slide in an extra chair for you. We'll be running our 3-week-long I-Corps Spark program twice a month. It's pretty lightweight over the three weeks. One session kicks off tonight, but it's full. The next open courses start February 9th and then the 23rd. So pretty much every other week for the rest of the year. So for more info or to apply, just go to the website below or email us at the email below. Now that's the end of the infomercial.
Great.
So
thanks, Roman.
Deep tech startups are different from things like web and mobile apps. And your path, if you're on a deep tech startup, is much longer and more challenging with multiple phases. And different resources, different forms of organization, goals and funding sources, and different levels of risk at each stage. The session tonight addresses this, and you'll be hearing from someone who really knows as a NSF funder of deep tech startups, as an entrepreneur and as a VC. I just have to tell you that when I first met Errol, and he may not remember this, but it was March 27th, 2009. One of the ventures that I was mentoring called K-Splice had applied for an NSF SBIR, and the program director reviewing the proposal wanted to talk with them and told them to bring their mentor too, make sure he's there. That was Errol. So we were in a conference room at MIT when he called in. He really started drilling into everybody with questions. And it wasn't about the technology, it was about the business model. So we're kind of all looking at each other. We weren't expecting that really. And he started drilling into me, and I was just there as a volunteer. I think he used the F word a few times.
Oh boy.
My impression was that this was some scary dude. But I think, the team did okay and I probably didn't hurt him too much because by the end of the call, he told them that he was recommending their award only if they promised to read a book by Steve Blank. And this was like 2 years before I-Corps got created. So I'll turn the mic back over to Katie, and she can introduce Errol in a more formal way. Thanks.
Great, thanks, Roman. And I just want to also logistically say, if anybody has questions during Errol's talk, if you could just use the Q&A box in the bottom of the screen, put your question in there, and then we'll address it at the end of his talk. So Errol is actually an MIT alum. He's got a PhD in aero-astro engineering. He's also founder and CEO of M34 Capital, a private investment company. As Roman mentioned, he was a program director for the National Science Foundation's SBIR program, and he was also the founding and lead program director for the NSF's National I-Corps program. So I don't know, some of you might have gone through one of the national cohorts before. And Errol generally speaks at the sort of lessons learned finale at a bunch of those. So I've been fortunate enough to see him speak at a couple of those. So I think all of you are in for a treat today. So with that, I'd like to turn it over to Errol.
Thank you, Katie, and thank you, Roman. I had forgotten about the exact date that we had first met, but I do remember that phone call very well. And K-Splice went on to be very successful, and it was a pleasure to support them as a supporter of academic spinouts from the federal government. And K-Splice is the sort of the poster child of what a federal funding program is really good at. It helps with basic research in academic institutions, supports the people as they are taking their technologies out of the lab, and then when possible, supports the pairing up with private resources, i.e. you, Roman, for the next step. And I believe that was part of the VMS support that you were working with K-Splice. Can you confirm that, Roman?
Yeah, I was one of their VMS mentors, yes. Yeah,
that's right. I remember that. Thank you. And you might not know this, Roman, but VMS was one of the programs that NSF studied as part of its background research in order to prepare for the Innovation Core program. And so the mutual respect goes both ways. All right, so I'm going to share the screen, and I'm hopeful that there is a set of slides up there that you see that says Deep Tech Startups in the Age of Blitzscaling. Can you confirm that you see that?
Yes.
I can see by the nodded heads that you see that. All right. So we're going to be talking about deep tech startups today. That's the area that I have the most experience with. Let me give you a little bit of my background. I was an entrepreneur many, many years ago with technology that was spun out of MIT, and then subsequently I took a startup out of Stanford and Berkeley using technology for drug delivery and deploying drugs across the stratum corneum using an inkjet technology to shoot basically palliative care drugs across the skin. And so my background really is in hardware and new knowledge being applied to technology opportunities. And what we're going to be talking about today is some of the scar tissue from those years of doing deep tech startups, and in the context really of the age of blitzscaling. So some of you may know that the blitzscaling refers to a book that was written by Chris Ye and Reid Hoffman that was published in 2018, whose subtitle is The Lightning Fast Way to Build Massively Valuable Companies. And really, it's made the rounds in Silicon Valley. It was very popular, pre-COVID, obviously. A very popular book that described in earnest how do you scale a company in the face of enormous uncertainty and unknowns. But those uncertainties and unknowns were primarily market uncertainties and unknowns. And of course, in the context of deep tech startups, there's different risk elements that we're going to be talking about today that make blitzscaling a less effective strategy for moving a technology out of a lab. And just to provide some context, let me share with you some companies that have used blitzscaling and some companies that haven't. And I think you can look at this list and identify those that are appropriately used blitzscaling and those that scaled more circumspectly. And in particular, Tesla, a wild success from the market perspective right now, and thought to be a growth company. It's been around for about 20 years almost. And so at that point, you really have to look at the background of what the company did in their formative stages before they came to the notion of scaling. And obviously, they've been wildly successful most recently. Some companies that have blitzscaled to their detriment. Solyndra, many of you will know Solyndra as the company that received an enormous loan from the United States government circa 2008, 2009 to scale production, only to find that the market that they had identified was not there. Of course, Theranos, another company that is in the news, has been in the news recently with the basically the court cases around the fraud that occurred at Theranos. And that was another company that tried to scale before the technology was ready. And so there are multiple examples of companies that have tried to use the blitz-scaled approach and have used it to their detriment. And so what we're going to be talking about today is really those deep tech startups and the issues that face deep tech startups as they take technologies out of the lab, and what are the ways that you can go about thinking about financing them and getting the technologies into a vehicle that really can be subsequently scaled. Of course, Moderna and Ginkgo are both projects that have close ties with MIT and grew very thoughtfully prior to their opportunity to scale rapidly, which has obviously happened most recently. But blitz scaling works in situations where the primary risk is one of market. And Facebook, Twitter, and LinkedIn are all examples of companies that are obviously massively valuable that use blitz scaling as a technique. But my counsel is that you have to be thoughtful about when you apply the blitz scaling approach to your startup, because in deep tech startups, the risk profile that you have is different, and we have to be careful in doing so. So let me give you a little bit more about my background. I am the founder of M34 Capital. We are really a venture firm that focuses on taking academic startups out of academic labs, and basically the moniker, the subtitle is that we turn science projects into companies. And I sit on the board and had made seed investments in 3 companies that were academic spinouts: a company called Grossentia, which is out of Colorado State University, a company LSD Skin Science, which has technology from Cal Berkeley, and Neurotrainer, which is a technology company out of Vanderbilt. Grossentia develops a consortium of bacteria that help plants absorb phosphorus out of the soil, and was developed by soil scientists at CSU. They were a I-Corps company circa 2015, and we made our first investment in Grossentia in 2015. LSD is a company that uses bacteriophage to address skin microbiome issues, and they were, excuse me, an I-Corps company circa 2017. And Neurotrainer also was an I-Corps company circa 2016, and they are developing a virtual reality platform to address human performance in neuro brain plasticity. So all 3 of these companies are deep tech companies. There's science behind all of them, and all of them have faced challenges unique to deep tech startups that I'm going to share with you as we go through some of the elements in this presentation. Collectively now they employ approximately 50 people across the country. They sell collectively worldwide, and they are all examples of companies that used new knowledge to create value for the marketplace, and it's my privilege to be able to support them. 2 of them have SBIR funding. Neurotrainer has an SBIR award from the National Science Foundation, and Grossentia had an SBIR award from the U.S. Department of Agriculture. So let's talk a little bit about the reasons why companies fail. When we started the program to support academic spinouts, we asked ourselves, what are the primary reasons why companies fail? And we were fortunate enough that a firm, CB Insights, many of you will know, was doing an analysis right around that same time. And they did a postmortem of 101 startup and identified the top 20 or so of reasons why companies fail. And by far the biggest reason was no market need. This is true whether you are in a blitz scaling opportunity or you're in a deep tech opportunity. And running out of cash is really just another way of saying we couldn't attract the type of support that we needed because we didn't have a story to demonstrate that there was a market need. And so those two really are closely related. And we scanned this basically landscape and built a program called the Innovation Core to address what we thought were the most significant weaknesses of academic startups. And we're going to talk about that as we go through the presentation. But I want you to know that we based the program on the evidence that we had of the postmortems of 100 companies. And we also based the program that was developed on the experience of the SBIR program at NSF. And many of you will know that the SBIR program was started at the National Science Foundation. And it was my privilege to be part of the program from 2003 to 2011. And in that time, I saw about 400 companies, most of them academic spinouts, most of them deep tech. And here are some of the additional challenges that deep tech startups have above and beyond just a standard software or social local mobile application startup. So first, the time and cost variability. Hardware, look, it just takes longer, and it's more variable. If you have a material science project or if you have a biology project, that it times 10 sort of thing. So biology just sometimes doesn't behave, and a lot of the projects that we see right now in deep tech opportunities run the range of synthetic biology, CRISPR, and other new technologies and new areas of study that are coming on that are the tool set is still being developed and will probably still be in development for the next 20, 30, 50 years. With respect to regulatory, the deep tech has a regulatory environment that is different than startups, obviously. And just imagine what would happen if you shipped a car with an operating system as buggy as the operating system of your laptop. I mean, your car company wouldn't be around for long. And that's just a part of the maturation of the market. People expect their deep tech to work. It's kind of ironic, and they don't expect necessarily their software to work as reliably as their hardware or deep tech. Continuous release is really not an option in deep tech, and that has to do not just with the fact that there's a regulatory pathway, but it's just hard because you built this supply chain that is developing the output of your company, and that supply chain kind of is baked into your release reality, and so it's very difficult to have a continuous release mindset. And so because of all these reasons and more, access to capital for deep tech is more challenging. This is opening up a little bit as a result of, I think, some of the recognition that our future economic impact in the United States has deep tech as part of the future synthetic biology, artificial intelligence, material science, all robotics. All of these technologies are technologies that represent our future, and they are deeper in challenges than, say, the social mobile local that we are most used to funding here in Silicon Valley. So let's talk about financing deep tech, the primary reason or topic for today's discussion. And when you're financing a startup, there are really only two reasons to bring capital to that startup. Either you are mitigating risk or you are accelerating growth. This is true whether you're in a deep tech startup or not. Mitigating risk or accelerating growth. And there are different types of investors that will be around the table for those different elements of your life cycle. Let's talk about mitigating risk for just a second. So let me begin by first saying the sources of funding for innovation before we get to mitigating risk are really shown here. In the United States, there are about 7 types of funding pathways. And I'm going to cover a handful of these in the next several slides. But let me just give you an overview. Private equity, basically leveraged buyout, big bank, big finance, company profits. Obviously, that is usually not part of a startup's access portfolio. Commercial banks, again, not usually something that a startup can tap into, not until there's revenue generated. We've got nonprofits or grants. This is a very powerful way, especially if you're working in an area that has an affinity. Energy happens to be an area where there are some big philanthropic dollars that are deployed to advanced energy. And many of you will recognize that Elon Musk just announced a $100 million effort to help support carbon capture technology. The government, we'll talk a little bit about the government funds in the next couple of slides, but these represent primarily a small business innovation research program, but they also represent contracts for small businesses. The government is a great supporter of early stage innovation and activity. They have set aside programs that are meant to procure technologies and services from startups. And they have an investment program called the Small Business Innovation Research Program. That is probably the biggest innovation program, in government or not, in the world. And then there's, of course, angels, friends and family, basically people who've invested in you and are interested in your success, but may have a more friendly perspective on the upside of your business than, say, a venture capital group who is in the business of managing money as a fiduciary for other people's money, and they invest in equities typically to generate value and help grow the value of their equity. And we'll talk a little bit about that in just a couple of slides. So in deep tech, risk is distributed. And what do I mean by that? In all startups, there really is a risk profile along 4 lines. Some of you will have seen a graph that looks something like this before. There's technology risk. Does the technology work? Does it really provide the advantages that we think it does? There's team risk. Can the team develop the technology and market it to market and build the enterprise to be able to deliver reliably on that opportunity? There's a market risk. Does anybody care? The competitive landscape, is it such that you have the freedom to get in and move, or is it such a competitive field that it's unlikely that you're going to be able to rise above the noise? And then finally, terms and finance risk. Basically, can we make money together? And each one of these risk elements has a slightly different profile in deep tech startups than they do in more traditional software-based startups. And in particular, I'm going to talk about 3 of them: the technology risk, the finance risk, and the market risk. So because deep tech startups have a longer time to market, usually because the technology risk is higher, you run the risk of the market shifting out from under you. So in deep tech startups, you have to constantly stay attuned to what's going on in the market because you can't get a product out in, say, 3 months, 6 months. And so what was true when you started the project may or may not be true at the time that you're ready to launch the product or service. And so the target market risk for deep tech startups is just bigger because it's the product launch is further out, and obviously you don't know what's going to happen in the market between now and the time that you get to launch. Similarly, with respect to technology risk, you're not just shipping software, you're not just shipping a service, you're shipping hardware, and we've gone through what those issues are as a result of the deep tech nature of the work that or the project that you're developing. And then with respect to finance risk really revolves around, did I pay too much for this asset at this time? And again, time is not our friend when we talk about finance risk. And so one of the reasons why blitz scaling is such a popular approach to developing a startup activity is because you can deploy lots of capital very quickly and figure out whether or not there is a scalable business. And of course, that's very friendly to a venture capital firm who needs to deploy lots of capital and get the types of returns that are nearer in term than, say, a founder who's investing for 10 or 15 or maybe even 20 years horizon in the deep tech opportunity. So just the fact that there's the temporal component of deep tech is extended makes the finance risk bigger because of what you're competing with ultimately is the compounded interest of a bank loan. And so if I'm investing in your deep tech startup, the baseline is, okay, so what would I have gotten if I invested in zero risk bonds? Of course, that represents the tyranny of the compounded interest. So let's talk a little bit about how you think about your startup in this context of distributed risk. Your startup has a profile that looks something like this. I've highlighted that the finance risk might be a little bit bigger than the team risk, and maybe your technology risk is more or less than identified here. And your profile really determines what type of resources you can access. And if you're in this type of space right here, the target is you can use bank financing, senior debt, but the reality is that no startup is there, at least to begin with. And then you compare and contrast the other types of funding that are available. You might say venture capital has a threshold that looks like this. Your deep tech startup is not within the risk profile of venture capitalists, at least now, but over time it might become. Angel capital has a threshold that looks like that, not quite fit for most of the deep tech startups that we're talking about today. And your primary vehicle right now is, let's be clear, friends and family. So friends and family have a risk tolerance that is really just astronomical. It's off the charts, in fact. And they're willing to take a risk on you when nobody else will, because they've already invested, honestly, so much in your success to date. And then there's different types of funding mechanisms, accelerators, government grants, SBIR grants. And then through the applications of these types of funding, you mitigate your risk, you decrease your risk, and you get to a point where you can attract third-party private funds and then move forward with a more standard approach to getting to market, venture capital, equity, angel financing, and so on. So the question is, what is the business model of your financial partner? Because you're going to be asking yourself, which one of these partners is most appropriate for me? And the answer to that question is going to be determined by what the business model is of your financial partner. And it's important to know what the business model of your financial partner is, because as soon as you take money from your partner, their business model and your business model merge. Namely, they impose their business model on you. And it could run the range of friendly friends and family, all the way up to a leveraged buyout. And I think you can see the difference, the contrasting difference between the friends and family on the lower left and of course the leveraged buyout on the lower right. And understanding what the different models are determine whether or not there's a good fit for you in that particular pathway. The middle here is the government funding. The top right is basically a grant, and then the top left is standard venture capital with the analyst doing the analysis and prep of a deal being made. So how do you determine what is the business model of your financial partner? That's a question that I often get asked. And the answer to that question is, well, you do it pretty much the same way that you determine what your business model is. And of course, your business model is uncovered using any number of techniques. In the Innovation Core program, the technique that we favor is the business model canvas. and using customer discovery to uncover the elements of the business model canvas that are part of your part and parcel of your opportunity and activity. And basically what you do is you start off with a bunch of unknowns, and then through the course of customer discovery, you turn those unknowns into knowns. The idea is that you run your business in paper before you start cutting material. It's a very powerful technique to really understand and address the key risks that exist in your company. Those key risks primarily being, remember the CV Insights data, does anybody care? And this forces you to assess that. Does anybody care? And the way that you go about doing it is you use customer discovery, and I'm going to talk about customer discovery in the next couple of slides. But what I wanted to highlight here is that you can use this same framework of a business model canvas to understand what the business model of your financial partner is. And a government grant agency, believe it or not, has a business model. They have checks and boxes that they've got to deploy to or check to assess to see if they're addressing what their mandate was, what their mission was. And so the National Science Foundation, for instance, gets money from Congress and is entrusted with those resources to deploy for the purposes of maintaining America's preeminence in science and technology, and through the SBIR program, impacting its economic future by investing in high-risk startups that really can't be financed any other way. And some of you will know that Ginkgo Bioworks was received NSF funding when it was first getting off the ground. So let's talk a little bit about customer discovery. Customer discovery is the technique that you'll use to flesh out your business model. And I'm not going to go into great detail. There are literally books written on how to do this. But the key point is that what you're doing through customer discovery is you are taking an experimental approach to validating parts of the business model canvas. And the tool that you'll be using to do that is the minimal viable product. And I want to talk a little bit about that. Customer discovery is in essence taking your MVP out and testing it. And the minimal viable product in the context of a customer discovery really it's misnamed. It should be the minimal viable test. And what you're doing is you're going out and you're talking to different people, you're running experiments, testing, validating different elements of your business model, and you are basically trying to flesh out the business model by taking an approach to the market of technology adoption. And so you're trying to identify those people in the market that have an affinity for, an appetite for your type of solution, and those people are known as innovators, and then early adopters, and then early majority. And what this is a plot of is basically the technology adoption life cycle that was made famous by Jeffrey Moore in a book called Crossing the Chasm. And the argument is that every new innovation, every new technology that is presented to the market goes through a technology adoption life cycle that has this type of curve to it. And of course, this is the foundation of the famous S curve. If you integrate under this curve, you get an S shape. And through that S shape, you see technology adoption early on, and then you get to an inflection point, and then rapid growth. And then at the top of the technology, it sort of trails off. And then another S curve comes, and many of you have seen that. Basically, what this is saying is that you, as a startup, are trying to identify those people that are innovators and are willing to work with you in spite of all the weaknesses of your technology, in spite of all the weaknesses of your offering. They are so compelled to try new things. They have such pain. There's such a unique special opportunity that you can address together that they're willing to accept that, to accept the shortcomings of your company and of your offering. Now, embedded in this graph is also one of the critical elements of customer discovery that makes it so hard, which is that when you're out talking to people, running these experiments and testing validating your hypotheses and invalidating, you don't know who it is you're speaking to. Namely, you don't know what group they're coming from. And so people don't naturally have identified on their shirt or on their forehead whether they are an early adopter, an early majority, or a laggard. And part of your challenge is going to be to identify and filter the input that you get back from your exploration based upon where they sit in this spectrum. And the feedback that you'll get from a laggard will be entirely different than the feedback that you'll get from an early adopter. And you won't know a priori whether or not that person was a laggard or an early adopter. Usually in an academic setting, you can find people that are innovators because academic institutions attract that type of the people that are willing to just try it. Hospitals, on the other hand, are usually a little bit more conservative, and so you usually find people that have a makeup of a late majority or laggard when it comes to healthcare, say, than if you were going to a microbiology lab at MIT. And so understanding who you're talking to as you're going out and having these discussions is important because you're going to get information, and the signal to noise ratio is such that it's very, very difficult to really to get a strong signal, and you'll get lots of conflicting advice and lots of conflicting input, and your job is to try to understand and filter through the recognition or knowledge of where that person is coming from on the adoption curve. And I want to caution you that there's one bias that we all have that causes us challenges in customer discovery, and it's, of course, confirmation bias. So we all have a worldview that we are testing when we go out and do customer discovery. And it's common, in fact, to be able to hear from the world, no, 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 and still be able to scope out a yes, because we just want to hear yes when we're trying to validate elements of our business model. And so my experience is that in customer discovery, confirmation bias is one of the challenges that we face. And the only way to get good at it is to get good at customer discovery is to recognize the challenges of confirmation bias, know that you have it, and then as you're going out and testing, you work to develop a formal mechanism to address the biases that we all bring to the table when we're doing customer discovery. Now, I want to shift gears now to minimal viable products. This is, as I've said, MVPs is a bad name because we're not really building minimal viable products. We're building minimal viable tests. And the idea is, or the concept that we use in customer discovery is basically borrowed from the lean startup or the lean approach to measuring. And first you have an idea, and then you come up with some MVP to test that idea. And that MVP, it might be as simple as a spec sheet. It might be a landing page. It might be a mock-up. Don't think of an MVP as a beta prototype. It's really a tool that you use to test some element of your business model. And then you, of course, take that out and do some measurements, collect some data, and then importantly, you look for insights in that data. And that's the learning part of the loop. And so it's not enough just to collect the data, make the measurements. You actually have to absorb what it is that's coming back to you. And what you're looking for is some sort of insight, some aha moment, something non-obvious that is present in the data that allows you to see the world through some different lens or different approach so that you get that insight that nobody else has. And that's really what sets apart a valuable value creating enterprise versus a Me Too enterprise, some insight. Oftentimes that insight can be market related. Oftentimes it can be technical in nature, but there's some way of you looking at the world, and that's developed as a result of you deploying an MVP. Now, I want to take you through what I think is a great example of an MVP. Many of you will know a company called Eco ATM. This is the company that makes the kiosks to basically buy back cell phones, used cell phones, and it shows up and you find them in the Safeway and in the grocery store. Basically, you walk up to this kiosk and you plug your phone in and you answer a couple questions, and then it spits out a receipt, and you take the receipt and you go back to the cashier, and the cashier gives you the cash as depending on what the nature of your phone is and what the status of it is the screen broken and so on. This company was started with a grant from NSF, and I was privileged to be part of the team that underwrote this grant back in, I think it was 2006 timeframe. And this is an Eco ATM kiosk that was version 3, and basically it had everything. You plugged the phone in, you got the receipt, and took the receipt to the cashier. Out the door you went. But let me share with you what the MVP was, the version 0 was for Eco ATM. It looked like this. It was literally a cardboard box that had, a handle on it that kind of made it look like a mailbox. Had up on the top right place where you swipe your credit card or your ID, and then spit out cash. Concept was that it was going to spit out cash. Turns out that was a little bit too cumbersome, so they gave you a receipt, and then you went to the cashier to cash that. But I want to just highlight to you the elements of this MVP. It's got duct tape. It's got a couple dollar bills. It's got a sign here, hand-drawn sign. And this is what the company used to raise their seed financing. They put this out in front of their investors and said, this is kind of what it's going to look like. You're going to open it up, you're going to stick in this. I believe they raised something like $12 million, something of that order, using this MVP to convey the elements of the business. So remember, an MVP is not a prototype. It's a artifact for the specific purpose of testing some element of your business model canvas. Now, I want to talk a little bit about the creative process as we wind up here. Everyone on this call is working in a process to bring something new to the market, and in so doing, you're trying to make things better. You really are. You have a vision for this that drives you to create, and it's unique among builders and entrepreneurs and engineers to really do new things for the world, and many of us are driven by deep motivations. And I want to share with you what my experience with the creative process has been, and in so doing, talk about this graph here, which is happiness over time. Basically the 5 stages of the creative process. And in the Innovation Core, we often ask for, in the lessons learned, to provide a graph that is, success over time, or experience over time, or happiness. And this graph is commonly represented. You start off with possibility, and of course you're very high, and then you learn a little bit, and it gets harder, and you start to doubt. And then stage 3 is agony. This is the low point. Stage 4 is the aha moment, and then stage 5 is okay, I think I can do this. The finesse part. And I'm not exaggerating when I say, 75% of the teams that use this to try to plot out their experience in the creative process go through something like this. The reason why I'm sharing it with you is because in every startup that I've ever been part of, I've gone through something like this, and there are some parts that really are agonizing. And I just want to convey to you that there are people who've gone through this experience before, and one of the pieces of counsel that I want to provide you is to find a community that you can share your path with, so that as you go through this journey, you are not doing it alone, because I can guarantee you stage 3 is sheer torture. I want to share with you another way of looking at the creative process. This one has 6 steps, and the 6 steps go something like this. This is amazing, and then this is tricky, and then this is a stupid idea, and then importantly, I am stupid, and then finally, this might be okay, and then this is amazing. So every successful entrepreneur has gone through a journey that looks something like this. And the this is crap and I am crap part are very, very real steps on the creative process. And so I want to convey to you that to be expected. And part of my counsel is to identify a social network or a group of people that you can talk through these 6 steps so that you're not doing it alone. And I want to just end with building a company. We've talked primarily about the technology and the market flow in this presentation. Identify the customer segment, identify pains and gains, do the minimal viable test, do your iteration loop, and then build out a proof of concept. This is really where you do the beta. We haven't talked about that in great detail. But in addition to the technology flow and the market flow, there's the team flow and the financing flow, which we haven't talked extensively about. But I just want to share with you that building a company really is a complex set of pieces that need to all fit together. And while we've focused on this, other parts of your journey will focus on elements that look like this. And I didn't cover these at all, but I do want to convey to you that they are important. Companies fail at every one of these stages. My experience is that the most failures occur because they didn't get this part right. So focus on that top left before you start doing anything else. And if you do, you'll at least remove the top 3 or 4 reasons why companies fail by getting that top left part right. And then when you get to the point of scaling, you are scaling something that has you've executed and is proven to be valid. Okay, so let me give you my 7 takeaways. First, premature blitzscaling kills opportunities. This is especially true in deep tech startups. Deep tech startups have more failure modes than other startups, and there are limited investment and finance partners as a result. The federal government is most likely your nearest term investor. Learn your finance partners' business models, including if you're going to the federal government. We didn't talk about what the SBIR program has as a business model, but understand that there are different flavors of SBIR programs, and part of your journey is going to be to identify which ones are the right ones for you. The Department of Defense SBIR program is entirely different than the Department of Energy, is entirely different than NIH, it's entirely different than NSF, is entirely different than NASA. And so you just got to learn what those business models are so that you can figure out which is the right finance partner for you as you move forward. And then you're going to master customer discovery. It's a difficult challenge to master this technique, but it's important because customer discovery really never ends. In all of those companies that I described to you as part of the M34 portfolio, we do customer discovery to this day. You're going to master MVPing. You're going to make it a verb, and it's going to basically, minimum viable testing. And then finally, you're going to learn to love the creative process. And by learning to love the creative process, you're going to increase your likelihood of success. And of course, the I am crap part is the hardest. So that's what I wanted to talk with you about today. I'm hopeful that this was a meaningful exercise, and we have a few minutes for some questions.
Thanks so much, Errol. That was great. As always, it covers a lot of topics. And the one thing that I love about it is that it touched on the creative process, which a lot of talks don't. And I think that's really critical as people think about commercializing their technology. So we do have a few questions in the Q&A. So the first one, some agencies offer SBIR grants and awards while others include a contract. Are there any specific aspects that an early stage R&D focused startup should be wary about between these two funding options?
Yeah, sure. That's a great question. So just as point of clarification, the legal vehicle that is deployed by the agency is either a grant or it's a contract. And they really are different types of relationships. A contract is a vehicle where you negotiate a statement of work, and then you have to deliver on that statement of work. And you really are providing specific deliverables to the agency that is supporting that contract. And so your SBIR award in a contract approach is much more formal in the sense that you've negotiated a statement of work. A grant is a much more friendly program. It's basically, this is what I'm shooting for, and the leeway that I have in a grant to pursue that target is much more open. And so turns out that the National Science Foundation uses exclusively grants for its SBIR program. It's a very friendly program toward startups and spin-outs, because you don't have to renegotiate every element of the statement of work or any element of the statement of work as circumstances change. Whereas a contract, when circumstances change, you have to re-engage in a dialogue with your contract monitor to ensure that they are supportive of those new work orders. And so my general counsel is to convey that the different SBIR programs are friendly or less friendly towards startups depending upon the culture that they maintain. And it just so happens that the NSF SBIR program is very friendly towards startups. They use grants. The auditing process is very straightforward, and they have seen just about every strange, crazy occurrence that startups go through, and it would be difficult for you to surprise them.
Great, thanks. We have another question. How can we present MVPs to potential investors in the age of virtual meetings? Do you have any suggestions around that?
Yeah, it's a good question. I don't have any wisdom in this area. Obviously, all communications under the current pandemic are more difficult. You can't look people in the eye. You can't gauge body language as well. But the upside is that you can do a lot more meetings cost effectively. And one of our companies, NeuroTrainer, has this virtual reality headset that is part of its demo activity. And what we do there is we send out the headset in advance, and we've developed an MVP/demo experience that we ask the participant to go through, and sometimes we walk through them with it to give them the ability to get their hands on the experience. So I think every situation is a little bit unique. Anytime that you can get in the hands of your potential partner a demonstration, you should, even if it's a FedEx one-off that you send out and talk through as they're opening it up or after they played with it for a little bit.
So, Katie, excuse me for jumping in for a second. It's about 1:58 or 1:59.
Mm-hmm.
So their official time will be ending in a minute or so. Errol, do you have a few more minutes to hang around just if there are additional questions? And
sure.
I know many people in the participants may have another Zoom session to head to. We are recording this, and we'll get the links out to everyone that was here. But if you're available, we'll be hanging around for a few more minutes. Thanks.
Great. I also had a few questions that came in through chat directly to me. So one of them is, in your experience, what's the most common pitfall of an academic spin-out?
Probably the most common is to focus too much on the technology and to the short shift of the other elements of the business model. And when we looked at NSF had an assessment probably in 2010-ish, looking back at all of the phase 2 awards that had been part of the portfolio for the last 10 years at that point. And of course, in that portfolio, there were a number of academic spinouts. And there were a couple of strong findings. One of them was that those teams that had the ability to attract third-party financing were more successful in getting their projects to market. That's kind of a self-fulfilling prophecy. But also importantly, the person who was part of the team taking the technology out of the lab, usually the graduate student or the postdoc, or in some cases even undergraduates, those people that stuck with the project from the beginning to the end, or when I should say that when somebody stuck with the project from the beginning to the end, the project was more successful in getting commercialized and making a bigger impact. So those are a couple of things. The role of the professor was another standout. Usually the professor is most significantly plays a role of chief science or advisor or technology advisor, not a C-level spot.
Okay, that actually segues into one of the other questions I see here in the Q&A. If you have a full-time job as a researcher, how can we negotiate with our PI to carve out more time to participate in the I-Corps programs or educate ourselves more about these topics?
Well, I think that probably is a question for Roman. I'm sure Roman, you've addressed this quite a bit more than I have. Do you want to take a stab at that?
Sure. Well, it really depends on the individual PI, and I kind of would say let's do a mini business model canvas on the PI. In other words, kind of they want to help you, but they're also kind of thinking about what's in it for them, or actually the reverse. How does it negatively impact them if you do this? And I think we want to find some logic for them that kind of puts it in a comfortable place. And one of the areas, for example, I found is talking, and we can have a discussion with your PI. I've sat in on some of these, is to talk about how this is really not creating necessarily, you're not going to be building a venture in his lab immediately. You're not converting from researcher to entrepreneur, but it's a learning and education experience. And that fits into his job to provide you either as a graduate student or as a postdoc with the training and mentoring, for your career as an academic or in industry. And a lot of times that kind of resonates, and making sure that they understand that you're not going to be disappearing and not available to do the work that he wants you to. Does that make any sense to you, Errol? Absolutely.
So especially when you start talking about the education element of the motivation. I mean, that's part of the auxiliary role of a researcher and professor is to train up scientists and engineers for the next generation. And the I-Corps experience is a powerful way of facilitating that specific element.
And I think another way is also if you have a friend or somebody in another lab or who has another PI that has been through I-Corps and their PI probably is supportive of it, you can say, well, why don't you talk to your colleague over here? Because my experience is peer-to-peer communications, professor to professor works better than me trying to talk to him as well.
Great. I think we have time for one or two more questions. Given confirmation bias, at what point do you give up on revision of the hypothesis and decide to stop? Is there a go, no-go point, and how do you know what that is?
No, that's a great question. It's so situationally dependent, and it also has to do with your risk tolerance, as well as your opportunity cost, and as well as your access to resources. Sometimes the opportunity costs are so great that you should be just basically shutting this down to go do something more fruitful. Sometimes the opportunity costs aren't so great, and you can let it run a little bit longer to see if it plays out. But again, the signal to noise ratio not a lot of signal, and there's often a lot of noise. It's such a situationally unique attribute that I can't really provide general counsel. But what I can say is find people around you that know your profile, that know what your tolerance for risk is, that you can talk through the elements of the signal that you're getting back, and have them help you understand the nature of the potential confirmation bias. In the context of science, that is what's known as a peer-reviewed journal. In the context of entrepreneurship, it's your network, your advisory group.
So one last thing, I noticed that there were a few questions related to MVP, and I just wanted to point out that, remind people what Errol had said earlier was, so MVP, we're not really using the definition that's much of Silicon Valley or the world uses, which is really your beta product. In the customer discovery process, it's what kind of tiny test can you use? It might be on a piece of paper, and it's before you really build anything. So you may have to build a pilot project down the road somewhere, but that's not exactly what we're talking about here.
So final question, are there common attributes that successful entrepreneurs possess that you've seen?
Yeah, that's a good question. There are, and sort of a relentless pursuit of ground truth is a skill that really successful entrepreneurs have. In an entrepreneur, what they're doing is, their role is to really gather the resources to pursue the opportunity, and that opportunity needs to warrant the gathering of the resources, and then you have to communicate why that opportunity gathers the resources. And so being able to tell a truthful story that is also resonant is another skill. So I'd say that pursuit of ground truth, so that you're building on a foundation that really can support the type of work that you need to do, and then the ability to craft a meaningful story to attract the resources to pursue that. Those are the two things that I've seen that are common among most successful entrepreneurs.
Great. With that, I'd like to wrap it up, and thank you so much for joining us today and for your time. I think it's incredibly helpful, especially for all the people who are thinking about dipping their toe in the entrepreneurial waters, and really sort of giving them a little bit more of a view of what that looks like or could look like. And again, for those of you who haven't taken the iCore program and are interested, please go to our website, icore.mit.edu. And thank you again, Errol, and thanks, Roman, for jumping in and answering all those questions as well.
Thanks, Katie. Thanks, Roman. Thanks, Lisa.
Thank you, Errol. Thank you, Katie. Great job, Lisa.